Oh, a little Ace Ventura for you there. All right, all right, all right. A little Ace Ventura to loosen up a little bit here. We are going to have our first educational segment, ladies and gentlemen, from Schaeffer's Investment Research, and it is going to be Chris Prybal. Chris, what's going
Hey,
on? How are you,
hey,
sir?
good, Brent. How are you today?
I'm doing awesome, man. Happy Wednesday. What are you going to tell us about here for our first educational segment? Are you going to be telling us a little bit about Schaefer's, or a little bit of your own kind of knowledge?
I'm going to take you through a little bit of both and then hopefully conclude it. I'm excited today for the Benzinga Reopening Stock Summit
Yeah,
presented by Rocket Mortgage.
we are very excited to have you, and I will let you take it away, Chris. Let me know if you need a hand with anything. I will be standing by for you.
All right. Thank you, Brent. Once again, my name is Chris Prybal. I'm a senior market strategist and a quantitative analyst at Schaeffer's Investment Research. Schaeffer's is known for expectational analysis. Our founder, Bernie Schaeffer, was known for sentiment. So we combine sentiment analysis. Over 40 years ago, we've been in business with fundamental and technical analysis to create expectational analysis, which is our trademark. What we try to do at Schaeffer's is find holes in the Black-Scholes option pricing model. Fisher Black, back in '87 after the crash, there was much discussion, and he noted that there are unrealistic assumptions in the option pricing model. One of those is that volatility is known. We know from trading and investing, volatility is not known. It moves, it fluctuates. Also, that price changes in an orderly manner. We know that is not true, and the inability of a takeover or other into the option pricing model. We also know that there's flaws in that. One additional thing that I have highlighted is time.
Hey, Chris, can you hear me?
Yes, sir.
Hey, Chris, we can't see. I don't know if you know, but we cannot see your presentation. If you want to have the audience follow along, hit your, I think you hit your share screen button there. Trying to, yeah, there we are. I see it. It
I
says
think what had happened when I was on earlier, somehow I got logged off and now I'm back on.
it
So
happens,
you
man.
can see
You
this
are,
now, Brent.
yes,
Everyone can
sir.
see this, hopefully. Thank you for
All
your
good.
patience, everyone. I
No
apologize.
problem. Have at it, Chris.
The last note here was time. When Fisher Black made that comment in '87, I think we all realize now that time moves a lot faster than it did 40 years ago. So keep that in mind. Here are a few notable option trades that I've had over the past 2 months. I will specify and make you focus on the two put trades, Clorox and Walgreen Boots. I'm proud of those. Anytime you can trade a put and make money in a bull market, you got to be proud. I'm holding AMD calls and triple D calls that are doing very good. Also had an AMD closed out earlier a couple of months ago. This year, here are some of the notable trades I've had. I've had a 420. I've had a 488% on iRobot. I went back to back on GameStop for a 700 and a 650. I traded UX Steel for 400 and Capri for 453. These are all this year in Schaeffer's alert programs. Moving forward with real estate investment trusts, what are we going to do with these? What do you need to know? REITs are a very good hedge to inflation. I don't know if inflation is going to keep the pace that it has been, slow down. Going forward, though, real estate investment trusts have been a good hedge to inflation. Anyone that's ever tried to rehab a house or do remodeling know that the last bullet there, the replacement costs to rehab or fix anything have gone up. So you got to look at these existing structures and maybe provide more value than what the street is right now. REITs also provide stable income via dividends. By law, they're required to pay out 90% of their earnings to shareholders. That way, you'll never see a real estate investment trust company become a very large cap because they're paying out their earnings to shareholders every quarter. With REITs, you can have an ownership interest in present or future opportunities. So if you see a segment of the economy that you want to play, you can find a REIT that focuses in on that.
Hey, Chris, real quick, while you're in between slides, there's a little pop-up. I can't read it. It says to group something tabs together. Hit that little got it button. You see that little, it's up in your top left. There's a little, yeah, hit got it. Yes. Now we can see the magic that is your slides. Okay, awesome. Thank you very much, Chris.
Sorry about that again, Brent. I'll figure this out. after the show concludes, I bet. So with REITs, is it location, or is it opportunity, or both? Here are a few reopening REITs that are of interest based on our expectational analysis approach. The first ticker I'm going to highlight is Health Peak Properties. Health Peak Properties back in 2019 broke apart from Brookdale Senior Living. And since then, and interrupted by COVID, they've been transforming the company into more of a developer of high quality real estate in the healthcare asset classes, life science, medical office, and some senior housing. So they're transforming your business. The chart pattern you see is a daily one, and you can see the pullback to support. And in the bottom right-hand corner, that is a monthly chart. So I give the viewer here a daily and a monthly juxtaposition so that you can see the price action short-term and long-term. And as you can see in the long-term chart, it appears to be making a breakout. Vanguard, Cohen & Steers, BlackRock, State Street collectively own 42% of Health Peak. It's a $20 billion market cap based out of Denver, just moved there from California, and it's a 3.4% dividend yield. The sentiment side, analysts don't really care for Health Peak. Nearly half of the analysts rate the shares hold or strong sell, so you have upgrade potential. The next stop here is iStar. iStar is the parent company of Safehold, which tomorrow you have two of their speakers. I believe Jay Silverman is a keynote and Ian Selig is another speaker. So I look forward to their presentations. iStar, being the parent company of Safe, is focused on ground leases. If you're not familiar with ground leases, I might surprise you and say you actually know many ground leases. Many big box retailers, many fast food chains ground lease out their property, generate additional income, and reduce the risk in the overall portfolio. McDonald's, Starbucks, Dunkin' Donuts, you'd be surprised at ground lease companies, and I'm looking forward to their presentation. BlackRock, Fidelity, and Vanguard own 42% of iStar. And from the sentiment point of view, short interest on STAR has increased 139% in just the past 10 months. It's short interest to flow to 23%. We've also seen put heavy option activity, and it's only a $2 billion market cap, so it has plenty of room to run. And as you can see from the daily and the monthly chart, it is making all-time highs as we speak. The last company I'm going to focus on is Macerich. It's a fully integrated mall developer. They own malls, and I know you're thinking right now, oh man, malls are out of favor. That's exactly why I want you to focus on Macerich. They're turning around these malls. Vanguard and BlackRock own 22%, headquartered in Santa Monica. One thing I've noticed about Macerich is even though you'll see in the notes here that they guided earnings lower in their latest report, you'll see from the 8K, which is right here, that their leasing portfolio was up, and they had 18% more deals and 34% more square foot than the same pre-COVID period. And otherwise stated, they are on pace for their highest volume leasing year since 2015. So I don't know if malls are dead, and I like how they lowered the analyst estimate going forward, kind of lowball, and then they can surprise on the upside going forward. And you can see on this monthly chart, bottom right, Macerich has pulled back up almost 80%. So you're getting these shares at a significant discount. Lastly, if you have, thank you for your time today, Brent. Thank you, Benzinga listeners, for putting up with my issues there early on. If you would love to talk about your options trading or options analysis, you can visit us there at schaeffersresearch.com. And we have any listener questions or anything you'd like to add, Brent?
That was great, Chris. Thank you for sharing here today. Yeah, I mean, I have a few questions. So you're obviously very focused on real estate investing. We have an audience out there who is trying to learn a ton about, making decisions in the market and good ideas and good trades. You gave us a few here, but, what are some of the, I asked a similar question to our last guest, who was also a real estate guy. I mean, what are the key metrics that you're looking at when you're making a decision about a good investment or a bad investment? If you give us, top one or two or three data points that you're always going to be looking at when it comes to real estate.
When it comes to real estate, it's what you want to own. Real estate is usually one of the largest transactions people make. So it has to be thought out. You have to own something that you're interested in, that you think can make a benefit for the globe going forward, whether it be decarbonization or just lifestyle living. You want to own something that you are interested in. That way you feel like you're a part of that investment while you're also collecting dividends from that. And hopefully you get good price appreciation in the interim.
I mean, what is a good yield in your mind? A couple of our last presentations had a dividend yield that was around 6%. I mean, that's pretty hefty. When it starts getting up to what number do you sort of start getting concerned with the dividend yield, I guess?
When you say concerned, you mean maybe it's too high and that
Kind of
management is
thing.
not operating the company
Well,
properly?
not that it's not an operational thing, just maybe they are going to be looking to, cut back an expense or something like that. 6% is great, right? You have no concern with a 6% yield. If it's getting to 9%, are you going yay, or are you going, I'm wondering if they're going to have to cut the dividend soon, sort of
I'm
thing.
saying to myself, what is wrong with the market environment that they're operating in, that they cannot find an allocation for this capital instead of returning it to themselves and to the shareholders?
Right. That's a good way to put it.
There's something underlying that's going on when you see it that high. Otherwise, they would spend it on growth or an acquisition.
Good point. Good point. Awesome. Chris, well, thanks for joining us. If users out there, if viewers out there want to learn some more about some of your research, where should they go to find out more about Schaeffer's or more about Chris Prybal?
Schaeffersresearch.com is a good platform. Subscribers can find a lot of option content. Our trading ID, our services are on there. You can reach out to me via Twitter or LinkedIn. And to go back, Brent, on that dividend yield question.
Yeah, sure. Yeah.
You will see a lot of these faster growing companies only have a dividend yield of 1.5 or 2%. Mm-hmm. And that is because they're using the capital to grow the operations, not to return it to the shareholder.
Right. Absolutely. Yeah, it's a good point, Chris. Thank you for wanting to circle. I thought you were going to like that question about the dividend, and I think you did because you circled back to it there. Well, thanks for joining us, Chris. It's on the viewer. It's on the stream there. https://www.schaeffersresearch.com. Thanks for joining us, Chris. Have a good rest of your day.
Thanks again, Brent. Thanks again, listeners, for the problems there.
All Goodbye. Good. All good. It happens. And what do? We overcome.